Testing. Testing the microphone. Testing, testing. Good evening. Tonight we are going to discuss Chapter 2 in Accounting 101, Financial Accounting. Chapter 2 deals with transaction analysis. First, we need to distinguish what is a transaction. Most of you have been through Chapter 1 now. You've worked through some financial statements, talked about some of the principles of accounting and the objectives of accounting. And now we're going to step back and we're going to start looking at where do these numbers come from that are on these financial statements. So the first thing we need to do is start with a transaction. A transaction is any event that has a financial impact on the business. You can measure it reliably, so you have an invoice or a check, a source document that you have written or received for this item. It provides information about an exchange. For every transaction, you will have something given and something received. It's a trade-off. And the accounting records will show both sides of that transaction. For example, I purchased supplies for cash. I have more supplies, less cash. So here's a few examples for the Whole Foods market, which is introduced in Chapter 2 as an example company. It shows that we would purchase some fresh produce and then we would sell that produce. We might have to borrow money and then we would repay that loan once we had brought in enough money to pay that loan back. In order to record a transaction or do a journal entry, we have to first understand how to analyze that transaction. We have to know what an account is. We have to know how to list and differentiate between the different types of accounts. Are these accounts assets, liabilities, or stockholders' equity accounts? We learned that this, of course, is the accounting equation. An account is going to record all of the changes in each particular asset, liability, or stockholders' equity during a period, and it's a basic summary so we can come up with what the total is in that account. Your check register is an example of keeping track of your cash account, where you record all of your deposits and all of the checks you have written out in order to come up with your balance at the end of the month. So basically that's what an account does. A ledger keeps track of that balance for each particular account. So we would be keeping track of our cash, our accounts receivable, our supplies, our accounts payable as a liability. So assets are economic resources that provide a future benefit for the business. So we use these to buy, we use cash to buy inventory, or we buy inventory with a liability as a liability account. Accounts receivable is money that our customers owe us, and notes receivable would be money that we would owe to someone and they have a written promise to pay for that. I'm going to click through these slides fairly quickly, so hopefully we have time to do some examples and you have time to ask questions. Okay. We can have inventory, which is, if I'm Walmart, the inventory is all the items I have in the store to resell to my customers. Prepaid expenses are items such as I pay my insurance for 6 months and then I would expense it off a month at a time, or I might prepay my rent, something like that. Land is, of course, property, actual land property that I have purchased for use of the business. The building is where I'm running my business, the cost of that building that I'm using for my business, and of course, equipment, furniture, and fixtures. The items that we use, such as the heating and air conditioning, the computers, the office equipment, furniture, and fixtures in our buildings would all be depreciated items, which means we spread the cost of their use out over their entire life. Some liabilities we may have, which is liability is another word for debt. Accounts payable, what we would owe our vendors. When we purchase inventory on account, we would have an account payable. Notes payable is, again, money that we've borrowed from someplace such as a bank, and it's a written promise to pay. You sign a note. And accrued liabilities are liabilities would be something we owe for an expense we have incurred, but yet we haven't paid. And this happens with the type of accounting we're doing, accrual accounting. We record expenses when they have incurred. So if I am paying my telephone bill, I'm paying a month in arrears per se. So my telephone bill, I received my bill and it was for January and I pay it in February. I need to record that, and then I have a liability on my books until I actually pay the bill when February gets here. Stockholders' equity. There's several different stockholders' equity types of account, but they are the owner's claims to the asset of the corporation, what's left over after the liabilities. And so common stock is our investment in the corporation through ownership of stock. Retained earnings is net income or loss earned over the company's lifetime minus any dividends that you've brought in. And dividends are actually a distribution to our stockholders, and they are declared by the board of directors. Stockholders' equity accounts also include revenues and expenses. Revenues are the increase in stockholders' equity from delivering goods or services to the customers. This is for whatever we are in business to do. So if I'm Walmart, I'm selling my merchandise. If I'm an accounting firm, I am selling my accounting services. Expenses then are the decrease in stockholders' equity due to the cost of operating the business. If I am Walmart, I will have my cost of goods sold, my cost of inventory that I have to sell. If I'm an accounting service, then I will have the cost of my rent, my software, office supplies that I may purchase. All of those items are expenses that are going to be subtracted from my revenue. It doesn't decrease my revenue, but it's subtracted from my revenue in order to come up with my net income or net loss. So name two things that increase Whole Foods Inc.'s stockholders' equity and decrease their stockholders' equity. Increases in stockholders' equity in this example are the sale of stock and net income, and the decrease would be if we had a net loss or we paid out dividends. Digging a little deeper into transaction analysis, we are going to show the impact of these business transactions on the accounting equation. We're going to use Freddy's Auto Service as an illustration. This is also used in your textbook, but it's a good example and it helps you to see where the numbers come from. So we're going to assume that Freddy opened Freddy's Auto Service in April of 2014. So we're going to draw a little accounting equation here, and we're going to say that the assets that Freddy has are cash, accounts receivable, supplies, and land. His liabilities are accounts payable, and stockholders' equity accounts are common stock and retained earnings. And we're just going to show how each little transaction is going to affect this. Him and a few friends decided to invest $50,000, and in return they got common stock. This means they have $50,000 more cash, and there's $50,000 in stock. Remember, this has to be kept in balance. If I have an increase on the asset side, I have to have an increase on the liabilities and stockholders' equity side, because it is an equation that must be kept in balance with each transaction. If we purchase land for the new location and we pay cash of $40,000, we now have $40,000 less cash and $40,000 more land. You will notice in this case that we have actually, looking for my highlighter here, we actually have both of these are asset accounts, right? And we have the increase of $40,000 and the decrease of $40,000 both on the asset side. So this would not have any effect at all in my total accounting equation because it's just a plus and minus on the asset side. Okay. Let's see. Next transaction, we buy supplies on account, agreeing to pay $3,700 within 30 days. So when I buy on account, that will be accounts payable. One way to think about it is I bought supplies, those are an asset, so I owe for something, and it has to be a liability account. So in this case, we are going to record 37 increase in supplies and 37 increase in what I owe on the liabilities. We received $7,000 cash by providing services for customers. We're a service business, so we got cash of $7,000, and we earned service revenue, which right now we're putting under retained earnings because it increases our retained earnings. We would record this, actually record it as service revenue when we were doing our transactions or journal entries later, as we get to them in the second half of this chapter. Freddy's repaired a fleet of UPS delivery trucks, and UPS promises to pay Freddy's $3,000 within 1 month. So this is a promise to pay. We provided a service, and we have an accounts receivable, both for $3,000. They pay their $2,700 to the following expenses. They had rent of $1,100, employee salaries of $1,200, and utilities of $400. In this case, they have $2,700 less cash, and they have retained earnings of a total of $2,700 less because expenses reduce our retained earnings. Revenues increase, expenses decrease retained earnings. Freddy pays $1,900 on account, which means to make a payment toward the account payable. So we currently owe $3,700 in accounts payable, and we're going to pay off $1,900 of that. So we have $1,900 less cash, and we now owe $1,900 less. We look at a major stockholder paid $30,000 from his personal bank account to remodel his home. This will be actually no entry because his personal expenses don't go through the business account. Freddy performed services for UPS on account. The business now collects $1,000 from UPS. Their accounts receivable was for $3,000, and the UPS has paid $1,000 of that. Now the company has $1,000 more cash and only have a balance of $2,000 in their accounts receivable. Freddy received $22,000 from the sale of land, which is the same amount that Freddy paid for the land. The reason that's important is because there's no gain involved in this case. So he sold his land for some land for $2,200 and has $22,000. I'm sorry, has cash for $22,000. They then declared a dividend and paid the stockholders $2,100 cash. So they have $2,100 less cash and reduce the retained earnings by $2,100 because dividends reduce retained earnings. As we get a little further on and start looking at the rules of accounting, we'll talk more about the increases and decreases to retained earnings. But we would then total up each item, And in this case, we ended up with the balance of $33,300 in our cash account, $2,000 in accounts receivable, $3,700 in supplies, and $18,000 in land, for example. You will notice that both the total assets are $57,000 and the total liabilities plus stockholders' equity are $50,000. If you remember your balance sheet in Chapter 1, that had to be in balance, and this is no different. Your accounting equation must be in balance at all times after each transaction. Okay. And then to pull our financial statements, we just pull these amounts right from our little work that we were doing before. So we had service revenue of $7,000 plus $3,000. We had total salaries expense, total rent expense, total utilities expense, and then our net income is $23,000. Then we complete our statement of retained earnings, which is beginning, which is 0, plus our net income, minus any dividends to get our ending retained earnings. When we complete our balance sheet, we pulled this $33,300 right off the paper we had done earlier, listed our accounts, all of our assets to get $57,000, and we had our accounts payable, our common stock, our updated amount here for our retained earnings, which we got from the statement of retained earnings we just completed to get the total of $57,000. We need to analyze the impact of these business transactions on accounts. In order to do that, we are going to need to introduce double entry accounting system. For every debit, there will be a credit. Every transaction will include at least one debit and one credit, and debits and credits will equal within every transaction. So each transaction affects at least 2 accounts. It can affect more, but each affects at least 2. We'll look at the T account. What the T account is used for is to demonstrate the ledger, how we keep track of what the balance is on each account. So we have the account name listed at the top. This might be cash, accounts payable, accounts receivable, common stock, whatever account we're looking at. It's important to note that debit means left and credit means right. Credit does not mean good and debit mean bad. Credit does not mean add and debit means subtract. Debit simply means left or left side of the account, as we see is on the left side here. And credit means right side of the account. They mean left and right. When you're in the accounting world, when I say debit, I mean left side. Okay? When I say credit, I mean right side, period. The rules of accounting show the assets increase on the debit side. They decrease on the credit side. Liabilities do the opposite, and stockholders' equity accounts do the opposite. Again, this has to be done in this way in order to keep the accounting equation in balance. So let's go back and look at Freddy's, where we received this $50,000 in cash and gave them stock. What is the effect on the accounts? We would have a cash account and the debit because we increased by $50,000, and common stock because we increased by $50,000 to get the credit. This keeps us in balance. Debits equal credits, and the accounting equation would remain in balance. They had the $40,000 purchase of land. So now we have land, and we got $40,000 in land. Land is an asset. Assets increase on the debit or left side. Cash would be decreased. Okay. How do revenues and additional stockholders' equity accounts affect revenues and expenses? There are 2 categories of income statement accounts. Revenues increase stockholders' equity, and expenses decrease stockholders' equity. So to expand the accounting equation, we know that the blue here illustrates that stockholders' equity, all the stockholders' equity accounts, or the ones we're looking at in this example, are common stock, retained earnings, dividends, revenues, and expenses. Notice this negative. That means that dividends reduce stockholders' equity and expenses reduce stockholders' equity. And that also means that those two accounts increase on the debit side, where all other stockholders' equity accounts increase on the credit side. So here's the final form of rules of accounting. This is an important aspect that you may want to draw yourself out a copy and keep with you as you are working through your homework assignments. It is truly the rules of accounting. This is what you have to accept. If I say, okay, I received cash, then I have to know that I can look at this rule and say cash is an asset. And because it's an asset and I got more cash, it's the debit side of my entry or the left side of my entry. If I bought supplies on credit or on account, then I would have more supplies, which are an asset, increase on the debit side. I have more liabilities. I owe somebody more liabilities. If you look at the rules here, increase on the credit side. So I've kept my accounting equation in order or in balance. I make sure that my debits equal my credits in each transaction, right? And I'm following the rules of accounting. If I'm going to record these journal entries, first of all, a journal is a chronological order, chronological record of transactions. I'm doing items in date order. There are 3 steps. We have to specify each account affected by the transaction and classify by type. We determine if the account is increased or decreased, and we record it in the journal. This is something that really takes practice. You have to just practice in order to learn this. So let's look at, we had the business receives $50,000 cash and issues stock. Well, we know because of everything we've done so far, we know we've increased our cash. If we look at the rules of accounting, we would see that cash increase, well, we know that assets increase on the debit side, and hopefully we can identify that cash is an asset. Okay. And then we increased the amount of stock we had. Stock is a stockholders' equity account, and stockholders' equity increases on the credit side. Therefore, that would be our transaction. Remember when we were talking about the T accounts and I said it represents the ledger, so we can have increases and decreases in the general ledger? You will have a ledger for in your ledger you'll have an account as a totaling account for every single account in your chart of accounts, which we will look at a little bit later, yeah? And it's just a easy tool to quickly look at what your balances are in your accounts. After I've done my journal entry, then I need to post or transfer my information from my chronological order of my journal entries to each individual account in my ledger so that I can total that account up and have the amount to go on my financial statements. So right back to where you started in Chapter 1. So to transfer this balance, I'm going to actually, if I had a debit of $50,000 for cash, then it will go on the debit or left side of my cash T account here. The same thing for my credit. For stockholders or for common stock, I'm going to just move that to the credit side because it was a credit entry. Remember, debit means left, credit means right. So the process is basically a transaction happens, some kind of economic event has occurred within the business. We analyze that transaction, we enter that transaction to the journal, and then we transfer or post that amount to the ledger account. So let's look at some of these journal entries and walk through Freddy's as we're doing the journal entry and posting. So if you recall, we did this This transaction early on in the presentation of where we just showed that we had an increase of $50 to our assets and an increase in $50 to our stockholders' equity. How do we journalize that? We just did that a moment ago as well. So we are recording this where we're issuing the stock, and then how do we transfer that to our T account? We had an increase in cash and an increase in stockholders' equity. We go through this whole process. We paid $40,000 for land. We're representing up here where we actually did this. Looking for my, can't seem to make my highlighter go off. But we look up to where we actually did this entry. So we purchased land, which is an asset, have more land, and we paid cash for it, so we have less cash. Land as an asset, if I look at my rules of accounting, assets increase on the debit or left side. If my land is what increased, that's my debit. And I have less cash. Cash, or an asset, decreases on the credit side, which is what I'm representing here. Post my transaction. And again, this is in your textbook as well. Hopefully you looked at this example. This is exactly what we did earlier. Only now we're journalizing by doing the actual formal transaction and journalizing it in our general journal and then posting to the ledger. And that's what we're representing here. Supplies are an asset. Assets increase on the debit side. Accounts payable is a liability. Liabilities increase on the credit side. Rules of accounting tell us in what order we place it in the journal. Debits should be entered first and credits second to be in good form. So we perform services for our clients and receive cash. What two accounts will be affected? We have service revenue and cash. We received cash, so that means we have an increase in cash. Cash increases because it's a liability. Cash increases on the debit side. Revenues, our stockholders' equity accounts, increase on the credit side. Post that. We have our perform services on account. We have revenue and account receivable because we did not yet collect this cash. It's owed to us. That's why it's an accounts receivable. Accounts receivable are assets, increase on the debit side. We post this, transfer the balances. Keep noticing that we transfer these balances right down. Because accounts receivable was a debit, it goes on the debit side. Because service revenue was a credit, it goes on the credit side of the service revenue account. We pay cash expenses, rent of $1,100, employee salary of $12, and utilities of $400. Now this is an example of where we will have more than two transactions or two entries in our transaction, but you will notice that our debits and credits still equal. Okay, so we had rent expense. Expenses increase on the debit side. If you remember, by looking at the rules of accounting, expenses decrease stockholders' equity. Therefore, they increase on the debit side. Our salaries expense, utilities expense, and then our total cash that we paid out as a reduction in cash, $2,700 on the credit side. We would post to each of these individual accounts. Our 1900 transaction here, the same thought process works. We look at that and we say, what accounts are affected? Are they assets, liabilities, stockholders' equity account? Do we have more or less of that account? If I have more of an asset, it's the debit side. If I have less of an asset, it's a credit side. If I have more liabilities, it's credit side. If I have less liabilities, it's a debit side. We just follow the rules of accounting. And I'm going to just click through these. Y'all have access to these slides in the multimedia library if you want to go review it, and there's even other examples in them that I deleted out of these that you can walk yourself through. So this goes all the way through the process until we have all of, and I skipped a few slides to get to where I'm at here, and this is just showing all of the slides. After I have this process done, my next step is to construct a trial balance. Now, all a trial balance really does is it lists all of the accounts and their balances right out of the general ledger. You just go account balance order. So I'm going to start with my most liquid, which is cash, then my accounts receivable, my inventory, write down the list, and I will put if it's got a debit balance or a credit balance. And what this shows me is that my asset or that my debits equal my credits. That's what a trial balance shows me. It doesn't mean that I haven't made a mistake. It's a guarantee I made a mistake if my debits do not equal my credits, but it's not a guarantee that everything is correct if my debits equal my credits. We usually prepare this at the end of each period, and it helps us get ready to prepare the financial statements quickly. If you don't know all of the amounts, and you will find that you are asked to come up with missing numbers a lot. If you didn't pick that up out of your first chapter, you will learn it as you go along. So let's suppose that Freddy's auto service began May with cash of $1,000. During the month, they received cash of $8,000 and ended the month with a cash balance of $3,000. You can compute total cash payments by analyzing their cash account. If they had receipts of $1,000 or receipts of $8,000, started with $1,000 and have an ending balance of $3,000, we need to calculate how much cash we paid out. So how much would we have to subtract from basically $9,000 to get $3,000? And hopefully you all are popping up and you're saying, oh, I know the answer to that. And that would mean our cash payments were $6,000 during the month. So we can analyze our accounts and come up with different information just so we know if you understand the concepts. That's basically why we're doing this, because in the actual accounting world, you are always posting your transactions, and so you're not going to have your cash payment amount just sitting out there as a blank number. So we can compute either sales on account or cash collections on account by analyzing accounts receivable, assuming the amounts. So if we had $6,000 and we had sales on account of $10,000 and our ending balance of $5,000, then how much did we collect? Right? So how much would we have to collect? We have $16,000, $5,000 left. What do you think? The answer to that would be $11,000. Same thing here. We can determine how much we paid on account by looking at our accounts payable. We are looking for this number. What number would have to go here? 15,000 minus 11,000. Okay. Sometimes we do make mistakes. Accounting errors can occur, right? It happens. I'm not perfect. I make a mistake. I make mistakes. You will find that you make mistakes. One thing about it, as you make mistakes that you'll want to start learning is that one of the things that if you were in the classroom with me that I would say as you answer a question, I'll say, now, is that logical? Does that make sense at all that that is the question or the answer you gave me to that question? You need to recognize if something just seems off, and that, again, takes practice. So accounting errors can occur even in computerized systems. You can input data wrong. They may be entered twice or not at all. A debit may be entered as a credit or vice versa. You can look at these errors, and maybe you can determine what happened if I have a missing account. Then I can trace each account back and forth from the ledger to the journal. For instance, if a $2,000 transaction had been recorded incorrectly in the journal and posted incorrectly to the ledger, we would search for any journal for a $200 entry if I were off in my trial balance by $200. I can take my trial balance and I can divide that difference if I'm off by 2. Sometimes if I have treated a debit as a credit or vice versa, that doubles the amount of the error. So if I had a $3,000 error or $300 error and I divide it by 2, I have 150, so I might look for a $150 transaction. I can do something called a slide. That's where I have too many zeros. Instead of entering 40, I enter 400, or vice versa. Instead of entering 400, I enter 40. And I can do that by placing the decimal point in the wrong place. If I have a slide, the difference is divisible evenly by 9, for instance, $360, if I had a difference of 360 between my debits and credits on my trial balance and divided that number by 9, it comes up to 40, which means that I could be off by $40 and look for that balance, right? A transposition means I mix my numbers up. Instead of putting $2,100, I put $1,200. I just changed the order of my numbers. And again, this would be divisible by 9 evenly. The difference would be divisible by 9. Okay. If we divide 9 by 900, if we had $9,000 difference and I divided that by 9, I would get $100, and I would trace all amounts of the trial balance back to T accounts, dividends, and see if I could find where that amount was misstated. That's a lot of words, I know, but you just have to look for it, and that's the thing. There are other clues that would tell you where you were off. If you had an abnormal balance, meaning that you had a cash account that had a credit balance, then that should be a trigger for you to look and see what you did wrong, because cash should not have a credit balance. So you would be bouncing checks at the bank. That wouldn't be a good thing. Okay. I referenced the chart of accounts saying that along the lines of if we had a chart of accounts showing us, or your ledger would be in chart of accounts order is what I said. So assets would be listed first, then your liabilities, then your stockholders' equity. Every company has a chart of accounts that would tell you if you're getting ready to do journal entries, and in my accounting lab they're given to you, they say by your drop-down menu, it's which account do you want to use. Well, those are accounts that are in your chart of accounts, or they wouldn't be there. So again, the normal balances of our account, this is really important. Normal balance means increase side. So remember that. Normal means increase side, right? Normal means plus. So if assets increase on the debit side, then debit is its normal balance. Liabilities increase on the credit side, credit is its normal balance. Vice versa all the way down. We're not vice versa, but that's the same all the way down. The rules of accounting. Its increase side is its normal balance. So when we're in the classroom, I will say, what's the normal balance of cash? Or I might say, what is the increase side of cash? Or what's the normal balance of accounts payable? And you would say, credit, right? The right side is the increase side, or the normal balance. So when we're looking at the ledger account of where I'm tracking my ledgers, when we use this T account, then this is what we're looking at. Here's the T. So every time I see a T, I know that it's the ledger, that I'm representing a ledger. It's a quick way to represent the ledger. The actual account in a 4 column, it's going to show that you have your increase of $50,000. Again, this was from Freddy's, which gave us a debit balance. It's a 4 column. We have a debit and credit balance column. We have a credit then of $40,000. Well, when I reduced my 40 from my 50, I still have $10,000. So I still have a debit balance. Even though this is a credit entry, I am just reducing my balance. That's a 4 column. You can also have a 2 column, or not a 2 column, you could have a 3 column of where you just have a balance. And so in that case, you have to know if their normal balance is debit or credit, so that you, when you start with your beginning balance, you know if it's debit or credit to go from there. If we're only using T accounts to analyze transaction, and sometimes we do that, it allows you to look, and I will tell you, you use T accounts a lot when you're trying to figure out problems or correct mistakes in the real world. It's like, oh my gosh, we're off here. What kind of journal entry do I need to do to fix that my supplies are off by 50? So the first thing you see people do is pull out their pens and start doing T accounts and trying to say, okay, if I make this journal entry, then this is what will happen. If I do that, this will happen. And just look at what it takes to fix that entry. And it really does happen that way. Lots of times you hear that T accounts are just a classroom tool. And I tell you, every accounting job that I've had, we tend to see people pulling out the T accounts. When I worked for a for-profit public corporation, and we had to go to Indianapolis for corporate meetings at times, or talk about the financials at corporate meetings, and that was so often done. We would be sitting around a table and everybody's drawing T accounts. It's kind of hilarious, actually, but it does happen. So T accounts allow their managers to analyze these transactions very quickly. So if we were looking at Whole Foods and we wanted to borrow $100,000 to buy equipment, we can see how the whole transaction is going to affect us down the road. We can go right here to the T accounts, which, remember, when we were going through this process, the T accounts is the posting or the transfer. Putting something in the ledger does not put it on your books. I mean, you have to do a transaction first. Everything starts with the actual journal entry in the real world. This is just a quick look. I still have to go back and do my journal entry. So if I borrowed $100,000 cash, right? So I would end up with this $100,000 as I borrow, right? And I could buy this equipment. And then what happens? I have I spent this cash to buy this equipment, and this $100,000 is the money I borrowed. So my A is the borrowing, and the B is where I bought the equipment with that money. Now, I still have to pay off this loan at some point, this $100,000 loan. Okay, and that's the end of Chapter 1. Does anybody have any blaring questions right this second? Yeah, I made my PowerPoint mad. I also have here just a little Excel sheet that I've used before in the past, and it just is an illustration to show us how the rules of accounting work again. Assets increase on the debit side. Assets increase on the debit side. I might have said decrease. I'm not sure. Decrease on the credit. Liabilities increase on the credit. Stockholders' equity on the credit. Retained earnings on the credit. dividends on the debit because they reduce our retained earnings. If you remember your retained earnings statement, you subtract your dividends from your retained earnings and you add your income, and your revenues and your expenses here are your net income accounts. Revenues minus expenses equals net income, your income statement account. A few little memory hooks that you can use to help remember this is you can think, I say think DAD. Debit increases expenses, assets, and dividend. That's where the DEAD comes from. All other accounts, you will notice, increase on the credit side. So debit increases assets, expenses, and dividends. And all other accounts increase on the credit side. I have some other information here that is from other items as well, but one thing to think about is that the net income, the revenue minus expenses, is added to the beginning retained earnings, subtracted then our dividends to get that ending retained earnings for the period. We will do this closing process in the next chapter and talk about that. Again, the accounting cycle is you need to analyze your transactions, decide if you're getting more or less cash. So in an example I have here is we started a service business by investing $10,000 cash in exchange for stock. So the first thing that I need to do or think about is what accounts are affected. Well, it says I invested cash, so cash is affected, and I said I got stock, so that's common stock. So I have more cash, and the company has more common stock outstanding, and that's our cash would be increasing then, which means it's our debit entry, and common stock is also increasing, which means that's our credit entry right here, and we just go through that whole process. Are there any questions? All right, that's really the end of the presentation. I will just wait to see if there's any questions as you are looking back over this for a little bit, and then I will close down the recording. Have a great night.